Let's get right to it. Something fundamental has changed in the gold market. You can pretty much throw out the old models Wall Street used for decades, the ones based on simple things like interest rates and inflation. They just don't work anymore. What's happening now is that top investment banks are pricing something way bigger, the actual stability of the global monetary system itself. We're going to break down exactly how this new reality is completely reshaping how we should think about the value of gold.
And it really kicks off with this. This is a direct quote from Bank of America's head of metals research, Michael Widmer, literally telling investors to throw out their old psychological barriers. Now, this isn't some fringe prediction. This is a signal coming straight from the heart of the financial establishment, and the message is clear: the old rules are gone.
So, that leads us to the central question we're digging into today. What is going on behind the curtain? What is this powerful, shared logic that has caused the world's most influential banks, we're talking Goldman Sachs, JP Morgan, all of them, to come to these wild forecasts pretty much all at the same time?
Well, the answer is nothing short of a complete paradigm shift. For decades, gold was just seen as a hedge. You bought it when you were worried about interest rates or inflation. That model is broken. Today, gold is being repriced as a barometer, a gauge for the structural health of the entire global monetary order. Let's break down the two main things driving this.
Okay, driver number one, and this is absolutely crucial to understand. Central bank demand has become price inelastic. Now, what does that mean in simple terms? It means the world's biggest buyers are no longer just tactical traders trying to get a good price. No. They've become strategic, long-term accumulators who are going to buy gold almost no matter how high the price gets.
And the scale of this buying is just staggering. UBS is forecasting that central banks will snap up 950 tons of gold in 2026 alone. To give you some perspective on that number, a purchase that big effectively vacuums up a huge chunk of the world's annual gold supply right off the open market. It creates a structural floor under the price. So the obvious next question is, why are they doing this?
And this right here breaks down the geopolitical motivation. The huge turning point was back in 2022 when Russia's foreign currency reserves were frozen. For emerging market central banks, that single event just shattered the long-held trust in the safety of US dollar assets. So the motive now is crystal clear: get away from any asset that can be sanctioned. And the strategy? Treat physical gold as the ultimate neutral, sovereign reserve asset that exists completely outside of any single country's financial system.
Okay, so that's the central bank story, but that's only half of it. Let's talk about the second major driver, which is happening at the exact same time. It's not just governments. We're seeing a rising tide of real concern among private investors about the long-term sustainability of government debt, especially here in the United States. And this is what Wall Street has started calling the fiscal fear trade.
Goldman Sachs actually nails this with their fear and wealth model. It's brilliant. On one side, you've got the wealth driver. That's the emerging market central banks we just talked about, strategically moving their national wealth. But on the other side, you have the fear driver. That's Western private investors hedging against enormous fiscal deficits and the very real risk of currency debasement that could come from it. The key here is that you have two totally separate, very powerful groups of buyers all acting at once, creating this incredibly strong demand structure.
And all of this leads Goldman Sachs to a really powerful conclusion. They're saying the floor, the absolute fundamental starting point for gold's price, has been permanently raised. The old trading ranges we saw for the last decade, they're just not relevant anymore in this new world.
By the way, if you're finding this analysis valuable, please take a second to like, share, and subscribe so you don't miss any of our future deep dives. Okay, so with this new foundation set, let's switch gears from the why to the how much.
So we get the structural drivers now. Let's put some numbers on this. We're going to lay out the specific price targets from the major Wall Street firms. And what you're about to see is a pretty remarkable consensus.
Just take a look at this data.
What's really striking here isn't just how high the numbers are, but how tightly clustered they are around a specific range. You've got Bank of America, Deutsche Bank, SocGen, Citi, all converging right around a $6,000 price target. And even the more conservative calls from Goldman and JP Morgan are dramatically higher than anything we're used to seeing. The message from Wall Street is loud and clear. They see 5,000 as the new floor and 6,000 as a very real, probable target.
And honestly, this might be the most important point of the entire analysis. These banks compete like crazy, and they often have completely different views on the markets. The fact that they are nearly unanimous on the reasons why, the unstoppable central bank buying and the fiscal fear trade, that's way more significant than the small differences in their final price targets. It really points to a deep, structural shift that everyone is seeing. But of course, no serious institutional analysis would be complete without looking at what could go wrong. So let's get a balanced view here and explore the key factors that could actually challenge this very bullish story. There are really three main risks you have to keep on your radar.
All right, risk number one, which Citi highlights in their base case, is a global economic soft landing. Basically, if inflation cools down, growth stays okay, and geopolitical tensions calm down, that fear component that's driving investors into gold could really fade. In that world, you could see money flow out of safe havens like gold and right back into riskier stuff like stocks.
Second, and this is just classic market dynamics that HSBC points out, when prices are at historic, all-time highs, you're going to attract a ton of selling pressure from traders who want to lock in profits. This could cause some really sharp, volatile pullbacks, even if the long-term trend is still pointed up.
And finally, we have the classic headwind for gold. If inflation turns out to be stickier than everyone hopes, it could force the U.S. Federal Reserve to hold off on interest rate cuts, or maybe even think about tightening again. That would almost certainly lead to a stronger U.S. dollar, which historically is bad news for the dollar-denominated price of gold.
Which leaves us with this final, crucial question. On one hand, you have this powerful, unified, bullish story from all of Wall Street, built on de-dollarization and massive government debt. On the other, you have these very clear, identifiable risks. So as we watch the global monetary order literally reshape itself in real time, you have to decide, is gold re-emerging as the ultimate, timeless safe haven it's always been? Or are we watching the beginning of a giant, consensus-driven bubble?